Hi, so this is a video about understanding debt service coverage ratio for apartments, for office, retail, could be a different variety of assets, but we're just going to spend some time here for a few minutes. So let's just walk through the cash flow element of it. So you have your gross rents here of $100,000 coming in. This is specifically, I guess, for an apartment, let's say. And your vacancy factor is 5%. So that means your net rent is $95,000 a year. And then we're going to look at all of your operating expenses right here. So insurance, 5,000, maintenance, 15, management fees, about 10%, which is using that as a number, $1,000 for legal, property taxes, and other. So you got about $45,000, 500 for the total operating expenses. So to get to a net operating income, you take the 95,000 net rent minus the 45, you get the 49,500. Notice that the ratio is about 52% to the total rent. So that's your profit margin right there. So your expense ratio is about 48% or so. The reserve amount for this apartment is $250 a door. At 15 units is $3,750 because you're calculating this multiplied by this. Units by the $250 per unit. That's just a reserve amount that typically lenders will use. So your net cash flow then is the net operating income minus the reserve amount of $45,750. So let's just say, for example, the purchase price is $800,000. You put 30% down, so your loan amount is $560,000. We're going to use about a 4% interest rate, 25-year amortization, and your payment every year would be $35,846.07. So the debt service coverage ratio, remember, is the net cash flow right here, this $45,750 divided by the debt payment per year. So look at what we have, 1.28 times, which means that there's 28% cushion above break even. Now, for example, if you modified a couple of things, so well, gosh, Dave, I only want to put down 25%. Look what happens to the debt service coverage ratio. It goes down to 1.19%, which really won't work because the magic number is about 1.25 times. So you definitely have to put down about 30% in this particular instance to make it go well. So the magic formula, again, is net cash flow divided by the debt payment gives you a debt service coverage ratio. So that's your education today. When you're buying an apartment complex, we're calculating a debt service coverage ratio.